Imagine checkout without hesitation. You tap, you take your purchase, and you walk out with a payment plan quietly working in the background. No card declines, no ATM stops, no bank phone calls. That seamless convenience, once a niche fintech novelty, is now reshaping how consumers and businesses pay for everything from sneakers to software licenses. Welcome to the Buy Now, Pay Later evolution. A payments revolution that has sprinted from retail checkout lanes into embedded payments, cards, B2B financing, and the attention of global regulators. Today, we're tearing the curtain back. You'll learn how BNPL works today, why it exploded after the pandemic, what new models are emerging, and which macro trends are changing risk and rewards. We'll also map the latest regulatory moves, because this sector is not just innovating, it's being regulated fast. Buckle up, the future of consumer credit is being rewritten in real time. What is Buy Now, Pay Later, and how has it evolved? At its core, Buy Now, Pay Later is a short-term financing option that lets shoppers break purchases into interest-free or low-interest installments. Early models were simple. Pay-in-4 plans from fintechs like Afterpay and Klarna let consumers split a purchase into 4 equal payments over weeks. But the story since 2020 is one of relentless evolution. From a single product at checkout, BNPL has become a platform and an ecosystem. Embedded BNPL payment plans stitched into merchant checkouts, subscriptions, and invoices. No separate app required. BNPL cards and wallets, physical and virtual cards that route everyday spending into installment plans automatically. B2B BNPL, suppliers offering sellers deferred payment terms underwritten by fintech partners, bringing BNPL into procurement and inventory finance. BNPL as a service, white label BNPL tech powering banks, marketplaces, and point-of-sale providers. Verticalized BNPL, specialized products for healthcare, travel, education, and construction, each with tailored underwriting and repayment structures. This expansion changed BNPL from a retail gimmick into a payments infrastructure layer. And that's why merchants, banks, and investors care. Numbers that matter: growth, scale, and the fever pitch. BNPL's growth has been staggering and at times contradictory in headline statistics. Different studies use different definitions, but the overall trend is clear: massive expansion and mainstream adoption. Industry analysts forecast the global Buy Now Pay Later payment market to hit hundreds of billions this year, with some reports projecting totals around $560 billion in 2025 and sustained growth into the 2030s. Demand drivers include younger cohorts, who favor installment options, merchants chasing higher conversion rates, and embedded finance making integration easier for platforms. During the pandemic, BNPL saw a surge as consumers shifted online and preferred flexible payments. Merchant economics underpin the growth. BNPL providers typically pay merchants upfront, less a fee, assume repayment risk, and monetize via interchange, interest on longer-term plans, and late fees. Regulators are watching because widespread adoption introduces systemic consumer credit risk. Agencies like the UK's Financial Conduct Authority are moving BNPL into formal regulation, requiring affordability checks and access to complaint mechanisms. Rules expected to take force in 2026. Australia has already brought BNPL under the National Credit Code as of June 2025, meaning licensing, affordability assessments, and new disclosure rules. In the US, the CFPB issued interpretive guidance and reports studying BNPL products and their consumer impacts, signaling intensifying oversight. How BNPL works today. The new playbook. Modern BNPL blends fintech underwriting with instant UX. Here's the typical flow: checkout offer. At an e-commerce checkout or in-app purchase, BNPL appears as a payment choice. Instant underwriting. The BNPL provider runs a near-instant credit decision using alternative data, transaction history, device signals, and proprietary models, often without a hard credit pull. Merchant paid upfront. The merchant receives settlement promptly, improving cash flow and reducing chargeback friction. Consumer repays. The shopper repays in installments or longer term with interest. Providers earn via merchant fees, interest on longer plans, and late fees. Post-purchase engagement. BNPL providers leverage data to market promotions, extend larger lines, or embed loyalty features. Who's winning and who's shifting strategy? Large-scale players, Klarna, Afterpay, Affirm, PayPal, and 𝐓𝐻𝐻 continue to expand merchant networks and product suites. But the big strategic story is partnerships. Banks issuing BNPL cards, marketplaces embedding BNPL, and point-of-sale systems offering white-label BNPL. These partnerships transform BNPL into a payment orchestration layer, not just a loan product. On the merchant side, BNPL increases average order value and conversion. Amazon's partnership with Affirm and Shopify integrations illustrate how BNPL can be a revenue engine for platforms. For consumers, BNPL's appeal is clarity, split payments displayed transparently, and convenience, though the reality is more nuanced, with late fees and rollover options complicating the picture. Why regulation is shaping the next chapter. The BNPL boom attracted regulators for 3 reasons: unknown consumer risk, data and privacy concerns, and systemic credit exposure as BNPL use scales. The UK's FCA plans to bring BNPL under the same regulatory umbrella as consumer credit with affordability checks and a route to the Financial Ombudsman Service. Australia's legislative update in 2025 formally adds BNPL to the National Credit Code, requiring licensing and affordability assessments. In the US, the CFPB has produced reports and interpretive guidance exploring whether and how BNPL fits within existing federal rules and continues to monitor complaints and provider practices. What that means for consumers and merchants: new disclosures, affordability assessments, likely limits on late fees, and more standardized complaint procedures. For BNPL providers, it means heavier compliance costs, possible contraction of risk appetite, and reshaped product economics. New risks emerging. What keeps regulators and CFOs up at night? Hidden consumer debt. Easy approvals and reusability across merchants can create cumulative obligations that are hard to surface on one credit report. Studies and regulators have flagged concerns that consumers underestimate total exposure. Affordability and overextension. Without robust checks, BNPL risks becoming a mechanism for repeated short-term credit that leads to missed payments and collection actions. Data and privacy. BNPL firms collect rich behavioral data. How providers use and share that data, including for targeted offers, raises privacy and consent issues. Credit reporting gaps. Many BNPL plans don't appear on traditional credit files. This obscures true indebtedness from lenders and credit bureaus. Policymakers are debating mandatory reporting. Fraud and chargebacks. Fraudsters exploit account takeovers and synthetic identity to access BNPL lines, and disputes constrain merchant-provider relationships. Model risk. Fast underwriting models relying on alternative data require constant tuning. Poor models under economic stress lead to higher delinquencies. Tools and tech that make BNPL manageable. Aggregators and dashboards. Use platforms that consolidate buy, now pay later plans across providers, so you see a single household or corporate exposure view. Budgeting apps. Sync BNPL installments to your cash flow calendar. Short-term visibility prevents late fees. Credit monitoring. Set alerts for hard inquiries, new BNPL accounts, or suspicious behavior. Reconciliation. Software. Automated settlement matching reduces merchant disputes and speeds cash availability. Affordability engines. For merchants and BNPL partners, integrate third-party affordability modules that use open banking and transaction data for real-time checks. Key risks to watch and how to mitigate them. Debt creep and hidden leverage. The most pernicious consumer risk is cumulative exposure across multiple plans. Mitigate with mandatory aggregated reporting to credit bureaus and by setting caps on reusable BNPL lines. Regulatory shock. Expect stricter rules, licensing, affordability tests, and limits on punitive fees. Build compliance flexibility into contracts and product roadmaps so you can pivot quickly. Data privacy and monetization. BNPL firms collect deep behavioral data, demand data governance clauses, explicit limits on data resale, anonymization standards, and breach notification timelines. Fraud and account takeover. Enforce multi-factor authentication, transaction anomaly detection, and loss-sharing clauses with providers to reduce friction in merchant-provider relationships. If you found this deep dive useful, take one concrete step today. Audit your BNPL exposure, create a single spreadsheet or dashboard listing each plan, due dates, and balances. Subscribe to Finance Facts for weekly breakdowns on payments, embedded finance, and smart credit strategies.